Hey, what's up, everybody? Welcome back to Investing Sucks, and welcome to another installment of the Your Company My Analysis series. And today we are discussing Goeasy. So this is a company that I had actually not heard of until it was mentioned to me by one of you guys. And to my surprise, this company has delivered pretty stellar returns over the years. You can see, looking back 10 years, almost 33% compounded annually, which is spectacular. And to my surprise, I hadn't heard of this company. And looking at what's caused such a good performance, it could be due to just the market valuing them more highly. So a multiple expansion, say like a price to book ratio going up, price to earnings ratio going up, something like that. Or it could be fundamentals driven, where they're actually improving the underlying fundamentals of the business at such a high rate. And it's not just due to a multiple expansion. But if we take a look at the price to book value per share, it's gone down in the recent months because, you know, it's a company that has to do with kind of like the banking and financial sector, which a lot of those types of companies, pretty much all companies, really have gone down a lot in the past 6 months or so. But if we go way back, we can see that even despite that fall, it's still trading about a 2 times book value per share, or price to book value per share, which is above the mean. So we can see here the mean is just under 2, and it's still at 2. So what it was before at 4 times was extremely high. So to me, this seems like a pretty healthy correction for this company. Okay, so who is this company and what do they actually do? Let's do this now at the start of the video so that we all kind of understand we're on the same page. So they are really a non-prime leasing and lending service provider. They have 3 main lines of business, which are Easy Home, Easy Financial, and LendCare, which is kind of a recent acquisition for them. So basically what happens is typically a customer with non-prime credit, which means you have a credit score below 720, which is seen as like high quality. Those customers don't qualify for credit with larger banks. So they use these non-prime lenders like Goeasy. And you're typically looking at loans for relatively large purchases, but not extremely large purchases like a business loan or something like that. It would be, I believe they're around $50,000. So it would be things like auto loans, even smaller things like furniture. And they even mention point of sale loans. So some of their loan originations are coming directly at point of sale terminals, which is pretty interesting because I didn't know that really existed. I'd heard of buy now, pay later, which is kind of similar to that. But that's another line of business that Goeasy is currently in. So it's generally relatively large purchases, but not massive loans. And keep in mind, they are non-prime lenders. And really the goal of the business is to help these non-prime lenders graduate to prime lenders. So you gradually offer them loans with succeedingly lower interest rates, which you're able to give them the lower interest rates because they're paying back the loans ideally on the higher interest rate loans. And because they do that, they build up their credit, they can get back to prime lending. So they kind of brand themselves as a way of helping these non-prime customers. So like I said, they do have point of sale agreements set up with several hundred merchants where they originate the loans at the point of sale. They recently acquired LendCare, which is another new line of business. And because they are a non-prime lender, you're going to see 2 different things in their loan portfolio that differ from traditional banks. So as we know, because they are a bank, what they do is they acquire capital through means. Now, they don't offer savings or deposit accounts or anything like that. So they acquire their capital by issuing debt. So being able to issue debt at relatively low interest rates is pretty important for this company. So that may be harder for them to do in the future. Although what we can see here is that the interest rate that they charge on these loans is quite high, extremely high, because the total yield on customer loans is kind of in the range, which this will be about approximately equal to the interest rate, is 36 to 38%. They are forecasting for 2022, and then pretty similar for 2023 and 2024. So literally these loans that they're providing have an interest rate sometimes in the 40% attached to them. So the reason they're doing that is because they're loaning money to risky customers. So in order to be compensated for that risk, you need to charge a higher interest rate. That's just kind of how lending works. But what you also see with that is a much higher charge-off rate, as we can see here. So this is the percentage of their loans receivable that they don't actually end up collecting. So they extend these loans, but either the customer goes bankrupt or for whatever reason, they don't actually end up paying them. So because they're dealing with non-prime customers, this is going to be much higher than what you would see with the usual bank. So 8.5 to 10.5% of their loans receivable end up being included as charge-offs, which if you've looked at banks before, you'll know that's extremely high. So that's really what is unique about Goeasy is they are focused on a specific subset of customer, these non-prime customers, specifically in Canada. They haven't actually expanded into the US, which, I think for them expanding into the US would be a huge growth driver because there are, literally millions upon millions of non-prime customers in the US. So that's a whole nother market that they're not tapping into yet. But as far as I believe, they're just focusing on Canada right now, which Canada doesn't have nearly as many of this specific cohort of non-prime customers as the US would. So we'll see if they are able to expand the US in the future. That's definitely one thing that you'd want to consider when you're looking at this company from a growth standpoint. But what I wanted to point out here is just what's unique about the company and help you guys understand how they differ from a traditional bank. Okay, so now let's look at some of the valuation metrics for Goeasy to kind of get an understanding of how the market has valued this company historically. So we've already kind of looked at price to book value per share. So I think we have a pretty good understanding of that. Now, because they are a bank style of company, not necessarily a bank, but operating kind of similar to a bank, the ones that I'm interested in is price to book value, which you just looked at, and then also the price to earnings ratio, because you can't really look at cash flow when it comes to a bank because it's different than a normal company, because free cash flow normally just involves cash from operations minus capital expenditures. But when it comes to banks and this type of company, they use their balance sheets and the loans on their balance sheet as the means of generating their revenue and therefore their earnings. So because of that, they do operate differently, where the assets that they have on their balance sheet are actually what is generating the money by extending those loans and then receiving interest on the loans and basically making money off the difference between the interest they pay to acquire debt and then using that debt and then loaning the money out at a higher rate of interest without, having too many defaults on those loans where customers don't pay them back. So if we look at the price to earnings ratio, it fluctuates a bit more. We can see the mean is about 12.74 across this time period, and it's currently at about 10.5. So I guess trading slightly lower than what it has historically. And then if we extend it all the way back, I'd imagine in 2008 is when it got quite low, but it's actually at its lowest point kind of in that early 2020 phase. And it has come down quite significantly. Now, the PE ratio for this company is a little distorted, and I'll go to the financials to kind of point out why that is. So if we take a look at the income statement, you can see, so this is kind of how a bank, or I guess this type of company's income statement will look. You see they have their interest and dividend income, the interest expense. So this is the interest they're paying to acquire that debt. And then they also earn commissions and fees off of other things. And then I guess they earn other revenue through other services that they provide to customers. And then this is the provision for loan losses. So this is basically the expense that they recognize for accounting purposes, because these loans that they're extending are highly risky and a lot of them aren't going to get paid back. So because by accounting rules or modern accounting rules, you have to match revenue with expenses, you have to basically estimate how much of the losses you're going to incur based on those loans that you're extending in order to match that. So it is the provision for loan losses. It is a guess essentially, or it's an estimate based on historical data and also the company's view of the general economy and the market on, what's not going to get paid back essentially. And they have all their other expense items, so stock-based compensation, salaries, and a pretty high operating margin, and one that has grown quite a lot over the years. When you can see 37.2% here, and just a few years ago it was only 21%. So we'll get into why that has happened. But basically the reason why their PE is a little misleading is because of these items here. So the gain on the sale of the investments. So this is due to basically they purchased a majority stake in a company that ended up getting bought by Affirm, which Affirm is a pretty popular company. It's a buy now, pay later company. And then they eventually, because of that, they had an unrealized gain because of that company that they own getting bought by Affirm. So this is not a recurring item, so to speak. It's something that is probably just going to occur. You're going to see it here, this large item here, $114 million of income. So, I mean, it is no doubt it's something that is good for the company. It's something that is positive for the business, but it's not a recurring item. So if we're projecting earnings going forward, we can't have earnings grow based off of this number here, the 316. We have to kind of normalize it. But going back to what I was talking about before with this operating margin, so the way we can kind of understand this is one cool feature Ticker Terminal has is it breaks down their segmented data. So we can see Easy Home, which is mainly leasing, and Easy Financial, which is kind of everything else. So Easy Home would be like leasing for people buying furniture. Easy Financial would basically be all the other loans that they're offering. And Easy Financial is a much higher margin business than Easy Home. And we can see over the years, Easy Home, their revenue's kind of stagnated. It hasn't really gone up. In fact, it's only gone up slightly. You can see in the last year is 150 million, but 4 years ago is only 143 million. So basically stagnant. Whereas Easy Financial has grown and grown fast. So really, if you're investing in this company and you're projecting them to grow in the future, that growth is going to come from Easy Financial. And Easy Financial is much higher margin. For example, if we take a look at here in their management discussion analysis section, it actually breaks down the operating margins for these two segments. And we can see here the Easy Financial operating margin, 44.7% for this period here, which is December 31st, 2021, versus 49.2% for the previous year. And that compares to Easy Home, which remember is mainly leasing operations, and it's much lower in the operating margin, much lower, 22%, and then 23.6% in 2020. So clearly, I mean, if you're investing in this company and what you're projecting going forward, if you're looking for something to believe that the company is going to continue to grow at an extremely high rate, earn much more interest revenue, much more income, and be able to pay that back to you in the form of dividends, make more acquisitions, or whatever the case may be for this company, or just internally retain those earnings and use the earnings the interest income that they get to then make more loans. So basically make them a less leveraged version of, this bank that they essentially are. The key driver of that future performance is going to be Easy Financial, which is much higher margin. So that's kind of what you want to keep an eye on as an investor in this business is, can this segment here continue to grow at its previous rate? Now, going back to the price to book value per share chart here, remember when we're looking at these things and we see a general upward trend over time, we can kind of decipher that could be due to two things. One, it could be due to the company becoming more profitable, so their operating margin going up, which we know is the case for this company, because then what that means is for each dollar that they have in book value, that dollar is now worth more because we know that dollar generates more actual earnings for the company. So we saw that reflected in the operating margin, which was due to the growth of Easy Financial. So to me, this kind of general increase that we've seen in the price to book value ratio is very much justified because the company's become more profitable. It's not like what you might see for other banks where the investors are kind of just piling into the stock because maybe they pay a generous dividend or whatever the case may be. And that's caused its valuation to just creep up a bit to the point where the valuation is a bit high and the future returns you're going to get aren't really what is good enough for you to compensate the level of risk of investing in them. So another key ratio that we could look at to, understand this even further, because I think it's an important concept, to understand this company, is return on equity, right? So this basically just compares, it's for every dollar of book value the company has, how much are they generating in earnings? Now, we know it's going to be skewed pretty high in the past 2 years because of, basically that investment they had in the company that got acquired by a firm. But even before that, it went from 16, 17, 20, and then it's kind of hovering around 20 and then shot up a lot because, their earnings were inflated a bit higher than what they would normally be. So there is an upward trend in return on equity. So for each dollar of equity the company has, they're generating more and more in earnings. And I think as Easy Financial as a segment grows, ideally, if it does do that, then you're going to see, return on equity go up and even the price to book value go up. Because that's just kind of common sense, as long as there's nothing profoundly wrong in the business, like if there's, they're experiencing a lot of credit losses, because they do have to kind of do that balancing act where they have to exercise discretion on who they loan the money to, but not loan the money to so few people that they're not generating enough interest revenue. So that's kind of the balancing act for the bank. Now, the next thing I wanted to look at was the balance sheet, because so we know their largest asset is going to be their loans and leases receivable, because this is kind of the core of the business, and that's specifically the part of the balance sheet that is what's generating their income for them, and it makes up about 80% of their total assets. You can see 1.9 billion out of about 2.6 billion in total assets is just this year. They have about 100 million in cash on hand, which has been, I guess, fairly consistent over the years. And the largest liability is going to be long-term debt. So that's kind of their business model, right? Make sure that, the company itself is financially strong so they can acquire long-term debt at a relatively low interest rate, and then loan the money that they receive from that debt at a higher interest rate, and then profit the difference. That's the business model. It's pretty similar to the banking business model. So, I mean, also, if you're an investor in this company, monitoring their credit rating. So how credit rating agencies are looking at them, that's going to be important, because if they get their credit rating downgraded, that can really cause this spiral for the business that they might not be able to recover from, because then their interest rates are going to go up, their profit margins are going to go down. That means less money that they'll be able to pay out to investors in dividends or acquiring new companies. And they also have common stock, so 363 million common stock. So I guess they also issue common stock and use the proceeds from that to continue their lending operations. But they have even more in retained earnings. So, I mean, if you're looking at the balance sheet, kind of how this company is financing their assets, how much of it is liabilities versus equity, to me, it seems like a healthy balance just at a first glance. Total liabilities 1.8, and then even a good amount of in retained earnings. So the company's been profitable for a long time, and they've probably been able to retain some of those profits and use those profits as basically cost-free financing to generate more interest revenue in the future. All right, so now let's move on to the valuation aspect. So this is going to be us trying to project what sort of returns we would earn investing in this company for, say, about 7 or 8 years. So what I did here, so there's kind of two methods. I have two different tabs here, two different methods. One is the book value per share method. So I kept it pretty simple here, basically just taking their book value, their shares outstanding, seeing what the book value per share is, and then seeing how that changes trend over time. So book value has been increasing at about 26% per year, which is very strong. And we know that book value is a very important metric for banks, which we know this isn't really a bank, but it kind of operates similar to a bank. And then shares outstanding has been increasing at about 3% a year. So this number here is basically just essentially that minus that, which gives you that. So book value per share has been increasing at about 22.5% per year. So that's pretty strong. Now let's project that going forward using 15%. So just being more conservative. And we have good reason to be more conservative with that, because for example, if there ends up being a recession in the future, which who knows if that'll happen. There's a lot of talk that people are predicting a recession, but really it hasn't fully materialized yet. So we'll see. But if that does happen, what it means is they're going to have more credit losses. So a lot of those loans, if the customers aren't as financially strong, more of them aren't going to be able to pay back those loans. So there's going to be more credit losses, which means less revenue, and their earnings could even have some years where it's quite low. So I guess there's a little bit of a cyclical nature to this company, but let's, for the sake of it, assume that shares outstanding continue to grow at 3% a year and book value grows at 15%, which, based on what it has been historically, and as we could see with the growth of the Easy Financial segment, I think that's a fairly reasonable assumption. So then we get a book value per share in 2028 of 105.46. Now let's apply different multiples to that to kind of predict what their share price would be at that point. So if they had, in the low scenario, if it was 1, which we looked at historically, the mean was just under 2. So I kind of went a little more on the conservative side with 1, 1.25, 1.75, and then 2. And then we basically just multiply this number here, so our projected book value per share, by these numbers here in each scenario. And the current price is about $98 per share. So what would our return be in that case? Well, in the low scenario, it's pretty bad, only 1%. But in the high scenario, which isn't even that high, it's just slightly higher than the historical mean, 13.6%. Now that's a solid return. I'd like to target 15%, but I do think that these are rather conservative assumptions. And this is just the book value per share method. It's not a perfect method because it doesn't really account for dividends that the company pays out, because it's just looking at book value, really. It's not really looking at earnings. So let's look at the earnings method. And when we do this, we actually get much better results. So, and we kind of know why that is. So if we take a look at here, 2016 to 2021, earnings were growing at about 34.5% per year. So each year. Now we know earnings were skewed high due to the investment gain from PayBright. So PayBright was the company that got bought out by a firm. So I'm not going to, I'm basically going to disregard this year. So if we look at the earnings that I'm projecting for 2022, I'm actually using the 2020 number here and using that as kind of the base, because I kind of want to normalize it because 2021 was an abnormal year. And so earnings have been growing historically at a much higher rate than book value. And the reason for that is because the growth in that higher margin business, Easy Financial, which we've already discussed now. So let's say that shares outstanding grow at 3% a year, earnings grow at 20% a year. We then get earnings per share of about just under 30, 29.46 in the year 2028. And then we do the same thing we did for book value, which is take four different scenarios of what the price to earnings ratio could be. And then we get certain future share prices. So the results are much more favorable in this than compared to the book value method. And really the only reason for that is because we're assuming earnings are going to grow faster than book value, which we have reason to believe that that could actually be the case. So I think it's a reasonable assumption, but of course, if you guys have other thoughts and opinions, then let me know in the comments. And I'll update the current price here to 98, because price has been changing pretty much every day. And in the high scenario, even the high mid scenario, and even in the low mid scenario, the company looks interesting, right? We're getting that 15% annualized return. So based on this analysis alone, the company is definitely interesting. And it's a company that I'd want to look further into and kind of try to understand the risks a bit more. So before I conclude this video, let me just give you, I guess, a quick high level discussion of in my opinion, the biggest risk for this company. So that one major risk is the lack of a track record this company has during a recessionary time. So I'm showing here the price to book value per share ratio again, because this is a good barometer of showing, I guess, at what point in time investors were pessimistic versus optimistic for the company. So it kind of relates to this discussion here. Now, I know whether or not an actual recession will happen in the year 2022 or 2023, that remains to be seen. But this company was very small in the year 2008, which is kind of when the last major recession happened. So we don't really know what will happen to them if the economy goes bad for a few years, because they're just so small at that point. They didn't really have any major operations that got disrupted. And this company's ability to grow their loan portfolio requires consumer spending, because a lot of their smaller loans for purchases of automobiles, furniture, power sports equipment, retail, those were kind of the main segments they outlined. All of that requires a strong economy. It requires consumer spending to be abundant and, the consumer to be healthy, essentially. And if inflation, for example, if inflation stays high, then consumers are going to allocate more of their spending to essentials and not discretionary purchases, which, from what I understand, a lot of what they're financing are kind of discretionary purchases. You can make a case of whether or not something like an automobile is discretionary, if it's a purchase that people might put off if they can't afford it now because, their budget is just so tight because inflation is so high. And personally, I think we're already kind of seeing evidence of this, where you have retail stores like Target, for example. They announced in their most recent earnings that they have stockpiles of inventory on specifically discretionary items, and they have to sharply discount them just to sell them and just to move them. So their profit margins are being hit because of that. And it's just the reality of a high inflation environment. No one really knows when it'll end, or if it'll get worse, or if it'll get better. So in my opinion, because of that uncertainty, that's really the biggest risk facing this company, because There is, I think at the current price, there is still a decent amount of future earnings growth potential priced in, but it may not actually materialize because of what we just discussed. So in conclusion, I would say this is definitely a company I'm interested in. I think what my game plan for this company would be is to monitor the price, see if it falls more, and wait maybe until the next earnings report to see if they call out a decrease in their loan originations as a result of this high inflation environment and maybe a lack of demand for the purchases that they make money financing those purchases of. And maybe the consumer is not as healthy anymore and Canadians aren't willing to make those purchases for whatever reason, some sort of commentary on that. Or if the company basically says, nope, all is good, it's business as usual for us. And yes, there's some headwinds, but, the company's still doing well. And I could be wrong maybe in thinking that inflation will have that effect, but really what I want to see is the company provide some sort of commentary on it, because if their next earnings report is below expectations, they are going to have to justify that. They'll have to talk about it somehow. So anyways, guys, that's pretty much my thoughts on this company. So thank you so much for sticking around and listening to them. If you did enjoy, then please leave a like and subscribe if you're new to my channel and you enjoy this type of content. And I'll see you guys in the next video.